Welcome back to the Global Business Channel. We hope you're doing well, and as always, thank you for your continued viewership and support. In today's video, we're continuing our deep dive into the 40 recommendations issued by the Financial Action Task Force, better known as the FATF. Our focus today, Recommendation 9, Financial Institution Secrecy Laws. Now, you might be thinking, how complex can it be? Well, the entire recommendation is just 16 words long. Yes, literally 16. But don't let its brevity fool you. There's a lot to unpack behind those words. And as always, we're here to provide you with full value for your valued time. Here's what's coming up in this video. First, we'll break down what we mean by a financial institution under the FATF, just to make sure we're all on the same page. Next, we'll explore the concept of secrecy laws and how they function in financial systems around the world. Then, we'll dissect the exact wording of Recommendation 9, all 16 words, and explain their significance. After that, we'll look at some well-known jurisdictions that have built reputations, good or bad, around strong financial secrecy laws. And finally, we'll wrap up with a few key takeaways and insights. So stay tuned, we've got an insightful and thought-provoking session ahead. Let's dive right in. If you've been following us for a while, you'll remember we released a comprehensive video breaking down what qualifies as a financial institution under the FATF definition. If you haven't seen it yet, we recommend watching it after this one. Link in the description. Before we get deeper, it's important to understand exactly what the FATF means when it refers to financial institutions. So where can we find this definition? Well, according to the glossary of the FATF Recommendations Handbook on page 133, a financial institution is defined as any natural or legal person who conducts as a business one or more of the following activities or operations for or on behalf of a customer: acceptance of deposits and other repayable funds from the public. This includes private banking, lending, covering consumer credit, mortgage credit, factoring and financing commercial transactions, financial leasing, except in the case of consumer product leasing, money or value transfer services, including all systems used to transmit funds, issuing and managing means of payment like credit, debit cards, checks, money orders, and electronic money, providing financial guarantees and commitments, trading in money market instruments like checks, bills, derivatives, and so forth, foreign exchange, interest rate and index instruments, transferable securities, and commodity futures, participation in securities issues, individual or collective portfolio management, safekeeping and administration of cash or liquid securities on behalf of others, otherwise investing, administering, or managing funds or money on behalf of others, underwriting and placement of life insurance and investment-related insurance applicable to both undertakings and intermediaries, money and currency changing. So that's what the FATF considers a financial institution. This comprehensive definition plays a crucial role in understanding how secrecy laws should not obstruct compliance with FATF obligations under Recommendation 9. Stick around. In the next sections, we'll explore how Recommendation 9 advocates for that no secrecy laws can be used to block access to AML and CFT information. Secrecy laws, also known as financial secrecy laws or banking confidentiality laws, are legal provisions that restrict the disclosure of a customer's financial information by financial institutions, regulators, or government authorities. These laws are primarily designed to protect personal privacy, ensuring that banks and other institutions keep their clients' financial affairs confidential. In practice, they prevent third parties, including foreign governments, from easily accessing account information without going through local legal procedures. Common forms of secrecy laws include bank secrecy or banking confidentiality, tax secrecy, corporate secrecy, including anonymous ownership, and restrictions on information sharing with foreign authorities. Historically, these laws were seen as protecting personal and economic freedoms, but over time, they have become quite controversial. Let's talk about the reasoning behind secrecy laws. Proponents argue that these laws protect legitimate interests. They ensure financial privacy for individuals and businesses. They guard against political or economic instability in some regions. They uphold legal rights to confidentiality in sensitive transactions. For example, a business expanding into a politically unstable country might want to keep its financial plans discreet for security reasons. But not all secrecy is created equal, and that's where the controversy begins. While secrecy laws were built to protect privacy, they can also create a veil for illicit activity. In jurisdictions with secrecy laws that are strict with weak oversight, individuals can use anonymous bank accounts, shell companies, and trusts to hide illicit wealth. These laws have enabled money laundering, tax evasion, terrorist financing, hiding proceeds of corruption. Let's take an example. Suppose a corrupt government official in South Africa siphons off millions from public funds. He or she then opens a company in a secrecy jurisdiction, such as the Cayman Islands, and park the funds there. Due to secrecy protections, any other country, such as in this instance South Africa's investigators, would not be able to access the company's ownership or bank records. This opacity undermines global anti-money laundering efforts. Over the past decades, leaks have exposed just how damaging secrecy laws can be. The Panama Papers in 2016 showed how offshore law firms helped the wealthy hide assets. The Swiss leaks revealed how one of the world's most respected banks facilitated hidden accounts. And the Pandora Papers again highlighted how loopholes and secrecy laws are exploited globally. These scandals didn't just damage reputations, they revealed billions of dollars in untaxed wealth and criminal funds sheltered by legal secrecy. The OECD's Common Reporting Standards, or CRS, now requires automatic exchange of account information between tax authorities, and the United States Foreign Account Tax Compliance Act, or the FATCA, requires foreign financial institutions to report assets held by U.S. taxpayers. Many jurisdictions have updated their laws to allow competent authorities to access information even in the face of secrecy claims. This in line with Recommendation 9, as we shall see in the next section. These moves are all aimed at transparency, information sharing, and financial accountability. While transparency is essential to combat financial crimes, the right to financial privacy still matters. The challenge is to strike the right balance between transparency to prevent abuse and detect crime, and confidentiality to protect lawful individuals and businesses. A well-functioning financial system requires both, but with effective oversight and proportionate access by authorities. So, Recommendation 9 addresses the issue of financial institution secrecy laws. These are laws that protect the confidentiality of customers' financial information, sometimes called bank secrecy, as we just shown, and the recommendation is now outlaid on screen. The recommendation states clearly that countries must ensure these secrecy laws do not stop financial institutions from sharing information when needed to fight money laundering, terrorist financing, and other financial crimes. In other words, secrecy cannot be a shield for criminals. Why does this matter? Because criminals often exploit secrecy laws to hide illegal funds in bank accounts or complex corporate structures. The FATF wants to make sure that when law enforcement or regulators need to investigate suspicious activities, these secrecy rules do not block access to important information. This helps countries cooperate better internationally and catch criminals hiding behind financial privacy. To comply with Recommendation 9, countries must have legal provisions that allow authorities to access customer information despite secrecy laws, require financial institutions to share information when requested by competent authorities, and enable effective international cooperation by sharing information across borders. Many jurisdictions have amended their laws to balance client privacy with the need for transparency and compliance. This was covered on this channel under Recommendation 2. So, Recommendation 9 is a crucial piece of the global fight against money laundering and terrorism financing. It ensures secrecy laws do not become a loophole for criminals. Let's now take a look at some jurisdictions notorious for their secrecy laws. First up is Switzerland, often dubbed the grandfather of bank secrecy. Despite international pressure, Switzerland has maintained strong banking secrecy laws, making it a preferred destination for those seeking financial privacy. However, this reputation has also made it a hub for illicit financial activities, as highlighted by the Pandora Papers investigation. Surprisingly, the United States has been identified as a leading enabler of financial secrecy. States like South Dakota have laws that allow for the creation of fiduciary trusts with minimal disclosure requirements, attracting individuals seeking to conceal assets. The Cayman Islands is another jurisdiction known for its financial secrecy. With no direct taxes and minimal reporting requirements, it has become a popular location for offshore fiduciary trusts and shell companies. Moving to Asia, Singapore offers strong banking confidentiality laws. Banking secrecy is codified in Section 47 of the Local Banking Act, which prohibits banks and their officers from disclosing customer information to unauthorized persons. In Europe, Luxembourg provides strong banking secrecy laws and favorable tax treatment for investment funds. While it has taken steps towards greater transparency, it remains a jurisdiction of concern for financial secrecy. Next is Panama, which gained global attention with the 2016 Panama Papers leaks, as we saw earlier. The country offers strong banking secrecy laws and a favorable tax regime, attracting individuals and entities seeking to conceal assets. Moving to the Caribbean, with the island nation of Nevis, offers strong privacy protections for business owners. Their jurisdiction allows for the formation of limited liability companies with minimal disclosure requirements, ensuring anonymity for directors and shareholders. Next is Belize, known for its strong privacy laws and asset protection frameworks. The country's International Trust Act prohibits the disclosure of trust information unless ordered by a court, enhancing confidentiality for account holders. The Cook Islands is renowned for its robust asset protection laws. The country's International Trust Act criminalizes the unauthorized disclosure of trust information, ensuring high levels of confidentiality. Lastly, with Hong Kong offering a favorable environment for financial privacy. While it has made strides towards greater transparency, Hong Kong still provides mechanisms for maintaining confidentiality in business operations. These jurisdictions, although there are many more, illustrate the complex balance between financial privacy and the need for transparency. While they offer privacy protections, they also present challenges in combating illicit financial activities. To wrap up, secrecy laws aren't inherently bad, but when misused, they can become a powerful shield for criminals. The world is moving toward greater transparency, and financial institutions and countries must ensure that confidentiality doesn't come at the cost of compliance. A crucial rule that helps ensure financial secrecy laws does not become a safe haven for criminals. If you are in the compliance field or just interested in how global finance really works, we hope this video gave you a clearer understanding. Let us know in the comments what you think about financial secrecy. Should it be abolished entirely, or does it still have a role in modern banking? If you found this video insightful and helpful, please do take a moment to like it and subscribe to our channel. Your support helps us grow and continue bringing you quality content on important global financial topics. Thanks so much for watching. We'll catch you in the next one. Cheerios.